The second learning objective defines and applies the accounting period concept and the revenue and matching principles. Because businesses need periodic reports on their affairs, accountants slice time into small segments and prepare financial statements for specific periods, such as a month, a quarter, or a year. The basic accounting period is 1 year, and all businesses prepare annual financial statements. For most companies, the annual accounting period runs the calendar year, from January 1st through December 31st. Other companies use a fiscal year, which ends on a date other than December 31st. The year-end date is usually the low point in business activity for the year. Retailers are a notable example. Many retailers use a fiscal year that ends on January 31st because their low point comes about a month after Christmas. Companies also prepare financial statements for interim periods, such as monthly, quarterly, and semi-annually. The revenue recognition principle tells accountants when to record revenue, that is, when to make a journal entry for a revenue and the amount of revenue to record. Recording something in accounting means making a journal entry. The revenue principle says to record revenue when it has been earned, but not before. Revenue has been earned when the business has delivered a good or service to the customer. The company has done everything required by the sale agreement, that is, the earnings process is complete. The amount of revenue to record is the actual value of the item or service transferred to the customer. This exhibit shows two situations that provide guidance on when to record revenue for Smart Touch learning. The first situation illustrates when not to record revenue because the client merely states his plan. Situation 2 illustrates when revenue should be recorded after the e-learning agency has performed a service for the client. The matching principle presents guidelines for expenses. Expenses such as salary, rent, utilities, and advertising. These are assets used up and liabilities incurred in order to earn revenue. The matching principle measures all the expenses incurred during the period and matches them against the revenues for the period. There is a natural link between some expenses and revenues. For example, a company pays a commission to a salesperson who sells the services. Other expenses are not so easy to link to sales. For example, monthly rent expense occurs regardless of the revenues earned that month. The matching principle tells us to identify those expenses within a particular period, such as a month or a year. The business will record rent expense each month based on the rental agreement. Owners need periodic reports on their businesses. The time period concept requires that information is reported at least annually. Often companies report more than annually. To measure income, companies update their accounts at the end of the period, usually monthly. Let's look at Smart Touch for an example. On May 31st, the business recorded salary expense of $900 that is owed to the employee at the end of the month. Smart Touch's accrual entry was as follows: a debit to salary expense for $900 and credit to salaries payable for $900. This entry assigns salary expense to May, the month in which the employee worked for the company. Without this entry, $900 of May's salary expenses would be understated and net income would be overstated. The accrual entry also records the liability owed at May 31st. Without this entry, total liabilities would be understated.